Good afternoon, everyone. Welcome to the third in what may prove to be more than three of our Tax Insider webinars. An introduction to trusts and tax, Thursday, 29th of April, 2021. Now, I have to say that stay there, don't move. Right, I have to say that when Amir announced that this webinar was going to be about taxation of trusts, or trust, an introduction to trusts and taxation in sort of 50 minutes to an hour, I did kind of expect for him to finish off by saying this Zoom call will self-destruct in 30 seconds because it's something of a challenge. Without further ado, about this webinar, a tax-centric talk, you might have rumbled this by now, aiming to provide an introduction for asset owners and investors to the concept of trust. So we're going to cover what is a trust, try and give you a working definition with a simple example, three basic trust categories that you will commonly encounter, their uses and their annual income taxation, the tax implications for the beneficiaries of the trust and how they might be able to get their tax back, and they really should. Then we'll give you a bit more detail about discretionary trusts, which are kind of vanilla flavor for sort of more comprehensive tax planning. And then a bit of a light skip and a jump through special trusts and using trusts to save tax. And I need to emphasize that I'm assuming that all parties and assets are UK residents, and that we're talking about trusts being created now, not old pre-2006 trusts. So a brand new trust, or a quite new trust here. The rules did change quite comprehensively in 2006. I don't want anybody telling me that half the trustees are about to emigrate to the Cayman Islands for the next 4 or 5 years. That's not the kind of trust that we're talking about here. Okay, so trusts are everywhere. You'll find them in wills, you'll find them, a lot of pension schemes are trusts, small self-administered schemes, family type pension schemes. Life insurance policies should be written into trust in many cases, so that when the policyholder dies, the proceeds of the life insurance policy fall outside his or her estate. If your life insurance policies aren't written into trust, then maybe you should check why, although that shouldn't be considered to be financial advice. Almost all property, bricks and mortar property owned jointly, is technically held on trust for sale. So they're everywhere. I'm going to try and give you a working definition of what is a trust. It's in full knowledge that this is going to bring tears to the eyes of trust specialists everywhere as I ride roughshod through many centuries of trust law and taxation. 3 people and some property. And when I say property, I don't mean bricks and mortar and land. I could be talking about a car, money on deposit, share portfolio, painting or more, or any family heirlooms. So we talk about property, but it doesn't necessarily need to be bricks and mortar here. There is a settler, the original owner, who passes a bundle of assets, what is to be the trust property, to the trustees with a set of instructions, making the trustees legally responsible for those assets. Look after this property, these trust assets, for the beneficiaries, for the benefit of the beneficiaries, to the advantage of the beneficiaries. So everything that the trustees do is not for them, it's for the beneficiaries. I hope that makes sense. We're going to look at an example now to try and put some meat on that. Fred is married to Wilma. Fred has 2 children from previous marriage. Now, chasing dinosaurs for 30 years, there's not a lot left in Fred at this stage, and it's considered quite likely that Fred is going to predecease Wilma. He's going to die before Wilma. Fred's will instructs Rubble solicitors to act as trustees in the event of his death. I'm not going to try and do the voice. When I die, look after my share of the family home and portfolio income for Wilma's benefit until she dies or remarries, whichever the sooner, then everything to my children, Dino and Dinah. Okay, so that's quite a common scenario, although in reality, of course, it's much more complex than that. I just want to pick up on a couple of points here. To analyze the example that I've just given, Fred is obviously the settlor, and the trust property is Fred's assets on death, his death estate. And here we're considering only some half share in some bricks and mortar. And let's say that Fred has a share portfolio. There might be 20, 30, 40, or 150 different things in the portfolio, but let's just consider those two things. The trustees, Rubble solicitors. And the trust is created essentially at the point of death. And it's only triggered if he dies before Wilma. It's entirely possible that Wilma could predecease Fred. And the point is that the trustees are now obliged to ensure that Wilma has the unfettered use and enjoyment of the family home to occupy or to let out, and the income from Fred's share portfolio until she dies or remarries, whereupon the actual physical assets themselves then pass through to Dino and Dinah. So Fred's a settlor, the trust property is Fred's assets on death, the trustees are Rubble solicitors, and the beneficiary initially is Wilma, and then ultimately the beneficiaries are Dino and Dinah, his children from the first marriage. Now, it's entirely possible that Wilma could have a similar provision in her will, assuming she's got one, leaving her half share so that Fred, if he survives her, can do what he likes with the family home. She might have an even larger share portfolio and an expensive collection of watercolors that she lets him use. And then maybe all her assets pass to her sister. So the point about this is that Fred is putting a safety device in his will, a mechanism to ensure that ultimately his children, maybe of no interest to Wilma, are protected in the long term or looked after in the long term. So we're going to look at some classic trusts now, having butchered that example. A bare trust, which is the simplest kind of trust, an interest in possession trust, which we've just met, and finally a discretionary trust. Now, there are lots and lots of different kinds of trust, but this is meant to be an introduction to the sort of three main categories that you're likely to meet. Really push the boat out in terms of my artistic abilities here. Hopefully you can see the concept that I'm trying to convey here is that the settlor passes trust property through to the trustees or transfers trust property to the trustees for the benefit of the beneficiary, or to the advantage of the beneficiary. In this scenario, the difference between the trust property and the beneficiary, it's the thinnest of thin trusts. The beneficiary is absolutely entitled to everything in the trust, the income, to live in a property, to rent the property out, and the underlying assets of the trust. The only thing is that it's not always an immediate right to everything in the bare trust. Generally, it's because the child is for a child, and the child is too young to take receipt of bricks and mortar. So there might be a time condition before the beneficiary can turn around and say, right, I want it, it's all mine, the trust is now finished. So just to summarize, the bare trust is the thinnest type of trust. It's considered to be transparent, and it essentially fulfills a caretaker role. Trustees have a legal responsibility to look after the assets, but beneficiaries have all rights to use, enjoy, benefit from the trust assets, any income generated, etc. The standard use that you will encounter is where grandparents or relatives set up a bank account for grandchildren, which they can take when they are aged 18. Now, I didn't say parents, because you have to be careful about parents settling assets in favour of their own young children. It generally effectively bounces back on in terms of the income, at least it bounces back on the parents, and the incomes need to be theirs. So it tends to be remoter relatives, if that makes sense. Also, you'll find it as a temporary vehicle when a parent dies with young children, because the child cannot legally own property, real property, bricks and mortar, until he or she reaches 18. So the trustee's name will end up on the land registry as a temporary measure until the child can give good receipt, or the youngest child, if there are several, can give good receipt for the real property. In terms of taxation, HMRC looks through their trusts as transparent. There's almost never a tax return for the trust itself, but there will generally be a tax return for the beneficiary that may have to be prepared by the beneficiary's parents or guardian. The income is treated as absolutely that of the beneficiary. So we're getting a bit more complicated now. We've got an interest in possession trust, which we've already met. This is actually Fred and Wilma. So the set law says, hold on to the trustees, hold on to some assets for now, and please make sure that the beneficiary, the immediate income beneficiary, commonly referred to as a life tenant because it normally lasts for that beneficiary's life, to get the benefit of, to use or enjoy, to get any income from, until such time as a condition is met. Then that interest in possession that the income beneficiary has ceases, and the underlying trust assets then move through to the ultimate beneficiaries. And I hope that you get that sense from that diagram. Okay, so just to summarize that what this means for tax purposes, etc. Yet again, the trustees have a legal responsibility to look after the assets, while the beneficiary with the interest in possession is entitled to use or enjoy income from the assets until a condition is met, which could be certain age, time, graduation from university, whereupon the assets are transferred out of trust to the ultimate beneficiaries. Now, in some cases, where it's a temporary vehicle and a will to ensure either surviving spouses are catered for, Fred and Wilma, or it can be the case that it's essentially keeping back the assets, just looking after the assets, or getting the trustees to look after the assets for a time, let's say until young children reach maturity. Now, that doesn't necessarily mean 18, it could be 25, it could be 30, it could be 60. But what in that kind of scenario, you're saying, let the children have the benefit of the income, let the children have the temporary benefit of whatever these assets have to offer, but not the assets themselves until X condition, where presumably you think that they can be trusted to look after the assets properly. Now, in this scenario, HMRC will require a trust tax return normally. However, the trustees, when they prepare their annual tax return, the trust is taxed at the standard or ordinary rate, so that's 20% for most types of income, 7.5% for dividend income. The income is deemed to belong to that income beneficiary because they have an absolute immediate right to that income. They can enforce that right. That's what makes it an interest in possession. So actually, the sort of mechanism here is that in essence, the trustees are paying standard or ordinary rate tax effectively on account for that income beneficiary, because that rental or interest or dividend income is then going to be passed through from the trustees to the beneficiary, and it's then going to be put again on the income beneficiary's tax return annual tax return for self-assessment. Now, the third flavour of trust that we have, and it really sort of really kind of reached the limit of my artistic ability here. I'm not quite sure what you might make of this, but what I'm trying to convey here is that a discretionary trust, unlike where in the case of Fred and Wilma's trust, where Wilma at the beginning had an immediate right to all the income that the trust assets generated, etc., etc. Here, the trustees have a wide discretion. They can decide that, in accordance with the settlor's instruction set, to give one beneficiary 50% of the income, all of an equal share, or nothing from 1 year to the next. So you might say, well, hold on a minute, why is that to the beneficiary's advantage? Well, it depends on what the long-term aim of the trust is. But the key thing that makes it a discretionary trust is that the trustees have the discretion to turn income tax on or off, and maybe favour one beneficiary over another, but always subject to the settlor's original instruction set. So yet again, trustees have a legal responsibility to look after the assets for the beneficiaries as per the settlor's instructions. Now, anybody who thinks that being a trustee is an easy job has probably never been a trustee. It's just a job, it's work, it's responsibility. You can either be a professional trustee like a solicitor, or you can be a friend or family of the settlor, in a will type scenario, looking after young children. It can be very, very challenging to try and guess what the settlor would have intended for the beneficiaries. But that is your role as a trustee. The trustee has no personal, is supposed to put to one side all their personal ambition, if you like, for what the trust might achieve. But the discretionary trust, they're working to that instruction set. They have some discretion as to if and how to apply any income or assets. So do we pay for tuition fees every year for one of the beneficiaries? Or do we ensure that they have a nice holiday? Or instead, do we just sit on the income for 3, 4, 5, 10 years, build up a pile of cash, and then say to the beneficiary or beneficiaries, here's £50,000 for a deposit on your first home? It all depends, and that is what the discretion means, and that is why it can become quite complex and demanding. And standard use, well, there's any kind of use. This is a very common type of trust that gives the trustees a great deal of flexibility as to how to apply the income and potentially assets in favour of the beneficiaries. And because of that flexibility, because the trustees can turn the income tap on or off or halfway or anywhere in between, and can decide to give some to one beneficiary 1 year, more to another beneficiary the next, the HMRC absolutely hammers discretionary trusts for income tax. They're always taxed at the highest possible rate. So 45% for rental income, interest, trading income that might come from the trust, 38.1% for dividends. And beneficiaries, well, the income isn't theirs until the trustees say, here's some income. It's not like an interest or possession trust or a bear trust. The beneficiaries are taxed only as and when they receive that income, if they receive any. Okay, so just to compare and contrast the three types of trust on one slide, a bear trust, HMRC basically ignores the trust and just taxes the income on the trust assets as if they were the beneficiaries absolutely. And the beneficiary, be they 55 or 6 months old, will have a tax return to complete. An interest in possession trust, in essence, the trustees have a their own trust tax return to complete, they will pay tax at 20% or 7.5% for dividends. They are doing so effectively. They then pass a certificate through to each of the income beneficiaries, the life tenants, and say, this year you received X pounds of rental income and we paid Y tax on your behalf. And another lump of interest, if there's interest paid, with Z tax, likewise for dividends. And that income is the income beneficiaries, and that income, be it rental, be it bank interest, be it dividends, goes on the income beneficiaries, the life tenants' personal tax return as rents, as interest, and as dividends. With a discretionary trust, HMRC will tax at 45%, 38.1%. The trustees may decide to pass some income through to one or more beneficiaries, but that certificate that they prepare says, we've decided to pay you X pounds of generic trust income. The beneficiary has no idea what the trust income actually was. They just get a lump of cash. It is generic trust income. It's lost its identity, and we have paid 45% tax on your behalf. So this leads me to this idea that when you are a beneficiary of a discretionary trust, then that you may well have tax to reclaim. So trust income, once it's received, is or receivable, is added as a component of the beneficiary's income. So the trustees will have prepared the tax return, pay the tax if it's not a bare or simple trust. And when a beneficiary receives income from a discretionary trust, they just get trust income. They do not know, and it's not relevant to them, whether the trust itself received rent or dividends or interest or trading income or partnership income or anything like that. It's just trust income. Now, if it's an interest in possession trust, that one where you have an immediate right to the income, the IIP trust, interest in possession trust, it's possible that that rental income that you receive from the trust, that dividend income that you receive from the trust, may take you into a higher rate of tax. So maybe the £13,000 of rental income, which has already suffered 20% tax in the hands of the trustees, maybe that takes you into the higher rate threshold, or it takes you above £100,000 of adjusted income. So you could end up paying more tax or owing more tax as an individual beneficiary, but it's far more likely if you are the recipient of generic trust income from discretionary trust, because that trust has been taxed so heavily already. It's quite possible that when the trustees give you that certificate, you're entitled to a refund, because you may well not be personally taxable at the additional rate for income above £150,000. Now, I should add, there's a provision in the legislation to allow the trustees to deduct the running costs of the trust from anything paid out to the beneficiaries. They don't have to bear the costs themselves personally in a personal capacity. They are allowed to say, right, well, we've had £100,000 with bank interest income. It's cost £1,500 to look after the trust this year. So we started with £98,500. There is also a bit of a trap for discretionary trusts where they have a lot of dividend income, because as I said before, the dividend income in the trust is taxed at 38.1%. But when they pass that certificate and the money through to beneficiaries, the beneficiary just gets a 45% tax credit. And if that tax credit is actually funded by the trustees having paid only 38.1%, the trustees have to claw more money back. Or the right way to phrase it is they have to withhold more funds to ensure that HMRC isn't out of pocket if that beneficiary then turns around and says, I would like all my tax back, please. Okay, trusts and capital gains tax. Generally, there will be capital gains tax to pay by the set law when gifting assets into a trust. A typical exclusion would be on death, or where there is some kind of postponement device in the legislation. CGT may be payable by the trust, assuming it has the power to dispose of trust assets from time to time. So let's say that in the case of Fred and Wilma, the trustees decided to sell some of those shares in Fred's portfolio. They may have increased in value from when they were acquired from Fred on his death. So that would just be a natural capital gains tax event. There's also potentially a capital gains tax charge when the beneficiaries finally pass through or distribute the underlying trust assets to the ultimate beneficiaries, the remaining men, which in the previous example were Dino and Dinah. However, there may again be exclusions. It depends on the nature of the asset and the circumstances of the trust. Trust and inheritance tax in one slide. Okay, so inheritance tax may be payable by the settlor when putting assets into a relevant property trust, bear with me, during his or her lifetime, 20%, not 40%, which is the death IHT rate. 20% is the lifetime rate. You don't normally see this, by which I mean, if I make a gift as an individual to another individual, we call that a potentially exempt transfer, not a chargeable lifetime transfer. And it's individual to individual. The only thing that I need to do is to make it an actual exempt transfer is survive the gift by 7 years. And that's what converts a potentially exempt transfer in 7 years' time to a really exempt transfer. But if it isn't warm body to warm body, if it isn't a live individual to another live individual, it will generally be taxable as a chargeable lifetime transfer. So IHT is immediately due at 20%, and that's what happens when you make a transfer to a trust, a relevant property trust. There's also a 10-year anniversary charge of 6% while the assets are sitting in the relevant property trust. Again, bear with me. So this is, nothing's happened. They just have to sit there, and there's a 10-year anniversary charge. There's also potentially an exit charge if the trustees decide to distribute some underlying capital assets, not the income, to the beneficiaries, and as the rate that's charged, it's normally quite small. It's up to 6%, and it basically depends on how long ago it is that the last anniversary charge was levied. Here's the kicker: most types of interest in possession and discretionary trust now count as relevant property trusts. So you've got lots of potential exposure to inheritance tax within sort of standard trust wrappers. And note in particular that you can have a trigger for capital gains tax and IHT at the same time. They can overlap. However, where that happens, you can normally postpone the capital gains tax charge by a joint election. So you can then swerve the capital gains tax and concentrate only on the inheritance tax. And you can potentially use the inheritance tax nil rate band, and inheritance tax relief may be available, such as business property relief, agricultural property relief, depending on the circumstances. And we will do a little bit of an example later on, provided I can bend space and time and get this done within 50 minutes. Okay, so just to recap, looking at the more complex discretionary trust, we're going to play a game, because I thought this might be fun, although your sense of fun may not be the same as mine. We're going to play a game called Spot the Taxing Opportunity. Okay, so 1, setting up the trust, passing trust assets from the original owner, the settlor, to the trust itself, potentially triggers capital gains tax and inheritance tax, normally payable by the settlor, but sometimes the trustees can agree to pay the inheritance tax, but we really haven't got time to go into that in any detail, really. The income in the trust, as it arises, is taxed at the highest possible rate, although beneficiaries receiving any income, if they get any, may be able to reclaim some or all of that tax. Don't forget that. Don't just assume that because the income tax charge is high, it's an inefficient vehicle. It isn't always. Having said it's not that bad for income tax normally. There's also a 10-year anniversary inheritance charge at 6% of the value of the assets in the trust, which can apply. And there's something a little bit sneaky on HMRC. If you thought that by not paying out the income and just sort of sitting it there, keeping it in the trust and not allocating it, just leaving it in the trust, might avoid an inheritance tax charge, the anniversary charge, that periodic 10-year charge, whilst also not triggering any income tax on the beneficiaries. You'd be wrong, because HMRC has decided that whatever the trustees say, whatever the trust deed says, that income is deemed to accumulate capital. It slowly solidifies over roughly 5 years into capital that is then potentially exposed to the 10-year IHT charge. And if that weren't enough, simply by appointing the assets out to the beneficiaries, you can yet again potentially trigger CGT and IHT. And this leads us to the broadly unavoidable conclusion that HMRC really dislikes most trusts, and in particular discretionary trusts. Okay. Trustees are legally obliged to act in the best interest of the beneficiaries, not the settlors. Now, the settlor can also be a trustee. That's perfectly acceptable. The settlor can be a trustee, but when he or she is acting in the capacity of trustee, he is not allowed to act in his own personal best interest. He must always act in the best interests of the beneficiaries. And you can imagine that in family scenarios, there can be quite a tension, a conflict here, particularly if the trust is, has been going for a few years, that the settlor sort of says, well, I really don't want to do it this way, but that's what the law requires. Now, if the settlor intends for himself or herself, spouse or civil partner, to benefit, to become a beneficiary in effect, to jump over the trust and go from being the settlor through the trust to sort of getting some benefit as a beneficiary, that is almost always a bad idea. And it does happen, but it's almost always by accident. We would normally consider that to be a bit of a bad thing, because the income in the trust then bounces back to the settlor, and it's considered that, in effect, those assets and the income therefrom never left his ownership or her ownership. And the regime is generally more punitive, and any reliefs that are commonly available to a trust are often denied if it's a settlor interested trust. So there can be reasons why you do this. There's sort of quite narrowly defined reasons why you might set up a settlor interest trust, but to sort of put it in simple terms, here be dragons. It's not, you very, very careful, and in almost all circumstances, you would go out with the express intention to ensure that the settlor and or his or her wife cannot benefit from the trust. Okay. You might have divined from all this that apart from some relatively defined scenarios and regimes, trusts are not generally now regarded as tax-saving devices. I will give some examples later on. Typically, the aim of a trust is to preserve assets for a long-term family benefit, such as protecting from the risk of what we might call an unfortunate marriage, or the risk of irresponsible decision-making by immature children. When I say immature, I don't necessarily mean 5, it could be 55. So there's often a non-tax, or at least one non-tax, maybe more, drivers to why you might want to set up a trust. And there's a lot of publicity in the general press about how trusts are some kind of arcane black box by which people's wealth can be hidden or masked. There is now a trust registration scheme where the existence of the trust has to be disclosed to HMRC. The identity of the beneficiaries and the identity, the assets have to be identified, So basically, everything within those very basic diagrams that I gave earlier on, the HMRC now has to be told about those. They're not anonymous anymore. Okay, some special trusts, pension schemes, small self-administered pension scheme is a trust. Great devices for holding commercial property for an OMB family company or family business, ensuring tax-free income and growth, typically low tax to the claimants when they claim their pension or on retirement, and they typically have less income. It's normally taxed quite benevolently, quite lightly. You can have trust for the disabled, or a trust for a vulnerable beneficiary, which includes young children who have lost one or more parents. And these can enjoy lower effective tax rates, lower actual tax rates, and inheritance tax and CGT protections, unlike other trusts, which are, discretionary trust generally is hammered for IHT and CGT. But note that the criteria for trust for the disabled, inheritance tax, capital gains tax, and a vulnerable beneficiary election are not consistent across all heads of tax. So don't assume that just because a trust counts as a trust for a vulnerable beneficiary, that it is also automatically going to qualify as a trust for a disabled person. Now, to give you a good example of when you might want to set up a settlor interested trust, imagine if a settlor is told they have a degenerative disease and they may in 5 years, 10 years time, be unable to administer their own affairs. That would be is probably not the right word. That would be an example of where you might the settlor might deliberately set up a trust from which he or she can still benefit, and it may also meet the criteria for a disabled trust on the basis that it is expected that they will meet those criteria at some point in the future. There are also discounted gift trusts. There's just examples of where you might find tax favored trusts. This is an IHT device, and I'm not sort of authorized to give financial advice, but just to give you a very simple appreciation of what happens here, a discounted gift trust is generally something that a cash-rich individual will take out, invest in. And again, very simplistically, the idea behind this is that the individual acquires a specific type of qualifying investment which ensures that they trade the value in their personal estate for IHT purposes for a promise of future income. The simple effect of this is that you swap, you reduce your immediate exposure to inheritance tax. Simplistically, the value of your estate will take a significant reduction. Right, I'm going to give you an example of kind of a simple planning using trusts. So Will and Grace are civil partners who jointly own a rental portfolio but want to transfer a property to their adult daughter, Gertrude, who some of you may recall from last month's webinar. However, their properties are all standing at significant capital gains. So if they just give the property to Gertrude, they will walk into a very substantial capital gains tax bill. Now, fortunately, they have not made any meaningful gifts, any substantial gifts in the previous 7 years. So their lifetime nil rate bands are standing at 325k each. So they set up a discretionary trust and transfer their respective 50% shares in a property worth 400 grand into it. Now, if you've sort of understood, or if I've correctly conveyed, you may think, hold on a second, does this not automatically trigger a capital gains tax charge? Does it not automatically trigger an IHT charge? Yes, theoretically it does. It triggers a lifetime charge, 20% on the value of the property passed in. However, they're each transferring in a 50% share, and they each have their nil rate bands of 325k, to cover their respective £200,000, roughly speaking, stake in that property. It's covered by the nil rate ban, so there is no IHT actually due. But because it is potentially chargeable to inheritance tax, they are also allowed to postpone the capital gains tax. Okay, so there's actually no tax physically payable when their respective half shares are transferred into this trust. A few weeks later, the trustees transfer the property out to Gertrude, benefiting effectively from the same mechanism as on the way in, because the value of the estate in terms of the exit charge is by reference to the chargeable value on the way in, and they can again hold over or postpone the capital gains tax charge that would otherwise apply, because IHT is nominally chargeable at the same time. So the effect of this is that no inheritance tax is payable on the way in the trust, or on the way out of the trust. There's no capital gains tax physically chargeable on the way into the trust or on the way out. But the capital gain has been deferred, which means that Gertrude acquires the property for her parents' original CGT-based cost, which is fair. You know, no capital gains tax has been paid, but when capital gains tax is due, it's by reference effectively to Will and Grace's, the parents' original costs. It's a deferral, but it can be a very long-term deferral. Now, Will and Grace have to survive the gift by 7 years to escape inheritance tax charge. There could be a catch-up charge on there could be a charge on death if they die within 7 years of making that gift. If they survive making that gift by 7 years, they will get their nil rate bands back, and they can, broadly speaking, they can do it again. There is still some unused nil rate band because they haven't used 650,000, they've used 400,000, so they could do it again within the 7 years on another cheaper property. So it will cost to set up a temporary trust, but it might cost normally a few hundred or £1,000 or something like that to set up a temporary trust as a device to do this, but it will save or postpone indefinitely inheritance tax and capital gains tax. Now, the one thing that I should also mention is that you need to be careful about properties that are subject to a mortgage. We assume in this example that it was mortgage free, because you could trigger a charge to SDLT, stamp duty land tax, or its devolved equivalent in Wales or Scotland, if the trustees and in turn Gertrude, the beneficiary, takes on responsibility for the mortgage on the way into the trust and then on the way out to. Agreeing to take on responsibility for the debt attaching to an asset can be chargeable to SDLT. Although, you know, it's not necessarily a significant charge, depends on the value of the property, and it isn't always the case that the trustees and or Gertrude need to take on responsibility for the mortgage. So, what have we learned? Well, we have learned that there are lots of trusts, they're everywhere, the blighters, and lots of different types of trust, and they can be simple, or they can be complex. And you know, you can have hybrid trusts, and you can have trusts that have assets that are subject to an interest in possession, while the rest of the fund is discretionary. They are generally not chosen for tax efficiency, but to protect assets. And there are a few tax-favoured trusts and a few scenarios where they can be very useful. And hopefully you've got a sense of when that happens. It's very rare for the original owner, the settlor, to put something into a trust and retain an interest in it without suffering tax-wise. More than 9 times out of 10, that would be a mistake. But there can, in some cases, be a very good reason to do so. And if I might add, one thing that we've also learned is that trying to shoehorn a webinar on trust into about 50 minutes is a bit mission impossible. Okay, hold on, sorry. some questions on that have been sent in over the last few days. Keith says, is there any way to minimize CGT on a property either transferred into or purchased by a beneficiary trust in the next couple of years? Keith, I have no idea what a beneficiary trust is. Just a quick drink of coffee here. Keith, I have no idea what a beneficiary trust is. It's not a trust that I've encountered, but I wonder whether or not there's something in the will and grace example that I gave earlier that might be along the lines of what you're looking at. Andrew says, I operate a couple of discretionary trusts and I found that banks will generally, I've seen this, banks like NS&I, and I'm sure there are various other banks that are similar, don't like setting up trust accounts, don't like setting up bank accounts, deposit accounts, savings accounts, where it's like Bill and Ben as trustees for, or Andrew for XYZ trust. And he asks, is there any way that you can sort of just set it up in your own name without an explicit reference to the trust? Will HMRC accept this, or is there a risk they could try to assess the interest on the trustees personally? Excuse me. Right. Well, yes, there is a risk by default, as banks provide any and all account holders with Section 975 annual interest certificates saying, you know, this is the interest that you've been paid this year and the amount of tax, if any, that's been deducted. And banks by default summarize all the information on all of their Section 975 certificates and then generally electronically give HMRC that information on block. But you can rebut this if HMRC asks or says, you know, we think you've had more interest income than is on your personal tax return. If you can prove that you have adequate evidence that there is a trust deed, documentary evidence of the source of the assets and how they've been applied, etc., etc. So from a tax perspective, this is not necessarily that problematic. It might be administratively a little bit complex, but from a tax perspective, which is all I'm authorized to talk about, really, then it's not that much of a problem. I would say check if the trustees have the appropriate legal powers, and I have no idea whether or not you're doing anything naughty in terms of not being full and frank with the bank. You might be. I have no idea. And he then says, is it okay for two trusts with the same, so it's kind of double or quits here, two trusts to share the same savings account and allocate the income between them? Okay, I think we're kind of moving out of the tax issues here. One thing that does occur to me is that there is then potentially a risk that you have this FSCS, this compensation scheme threshold of, I think it's 85k per deposit taker. If you are bundling large lumps of money into one particular deposit, are you then putting the beneficiary's assets? Remember, it's the trustees administer the assets, but it's for the beneficiaries. Are you then putting the beneficiary's assets at risk by doing it that way? Nick says, or asks, what are the tax implications, if any, of a trustee's decision to grant an interest-free loan to one of the trust beneficiaries, which would be repayable on demand? The trust would be a discretionary trust, not settler interested. So obviously, this is not Nick's first encounter with a trust. The simple answer is, I think it would be okay. And I've given various reasons there where I think it would be okay, but I don't really have that much time to go into any great detail. But it doesn't, I think the way that you explained it there, Nick, would actually work. There's a little bit more information on the slide there. Which I'm sure Nick will pick up in due course. Dinesh, a bare trust has been set up for a minor, 4 years old, with rental property. If the total annual rental income is less than the beneficiary's personal allowance, does the beneficiary have to need to have a tax return, or the guardian, as a guardian or parent, have to submit a tax return on their behalf. If the beneficiary has no liability, then he or she has no legal obligation to submit a tax return, and that's in the law, no matter what guidance or pronouncements HMRC utters, or however many cases they bring against directors who don't believe they need a self-assessment return, and HMRC then loses at the tax tribunal because they obviously haven't read their own legislation properly. But it will be on the beneficiary or guardian to make sure that this is monitored, to make sure there isn't a tax bill, because if you assume that you know no responsibility, and then you find out later on that you should have submitted a tax return, then the penalties can be quite high. I would recommend the guardian write to HMRC to explain why they don't feel that the beneficiary has this entitlement, but doesn't feel the need to submit a tax return. Although I would say if you do that, Dinesh, you almost guarantee that HMRC will formally notify you to request a tax return, in which case you will have to prepare one. Also, does a bare trust need to be formally set up? I would say yes, I think so. All right, Elizabeth. I am interested in the feasibility and advisability of setting up a trust for adult children with mental health considerations. Can you explain more? Elizabeth, I would love to. And it's a really good example of this. It may well be the case that the mental health aspects do not sort of take you all the way to being a trust for disabled or trust for vulnerable beneficiaries, which are the tax aspects. But this is a great, again, great might not be the right word, but this is an example of a scenario where it's a non-tax driver for setting up a trust, and very, very common for trusts to be set up for this purpose. Doesn't mean that non-tax favoured trusts should simply be discounted. Trusts are often set up for non-tax reasons like this. And that is me done.